I'm not even sure what I'm going to title this video as I'm saying this, but especially in this day and age, with low interest rates, high levels of inflation, and a lot of uncertainty surrounding the near-term future of a variety of investments, not to mention the economy as a whole, I do feel the need to discuss something that I often see hinted at, though rarely outright stated in the way that I'm about to, in the comment section of my channel, as well as other finance and investing channels here on YouTube. And that's the idea that certain asset classes or investments are bad to hold right now because due to either circumstances or the investing environment at the time, their expected future returns are likely to be, well, less than stellar. However, unless you're a fairly active trader, I believe that this is one of the bigger misconceptions in modern finance. I mean, look, on the one hand, I get it. Active trader or not, maximizing our returns is one of the most important considerations we make when choosing our asset allocation. This is especially true for those of us who are still relatively young and are going to be investing for a long time, because we have a lot of time for that money to compound. So even small differences in our annualized average return figures can lead to big differences in the amount of dollars we have in our nest egg when we finally decide to hang our boots up for good. It's also important for those who are nearing retirement, or whatever financial goal it is they're investing towards, since they don't have as much time to wait for the investments to bounce back in their favor if they should crash. And I'm not even saying that the people who say these things about these different investments or asset classes are wrong about the investment or asset's future return prospects. Every investment goes through booms and busts, so who am I to say that a bust isn't coming soon for the investment in question? I don't have a crystal ball. But what I think often gets missed, or at least is not discussed nearly as frequently when these types of conversations come up, is that the performance of the individual investments within our portfolio are not nearly as important as the overall performance of our portfolio. And for that matter, how that performance matches up with our needs and goals as investors over time. So, will bonds struggle in the near future? Will stocks? I don't know. But even if they do, does that necessarily mean that we shouldn't be holding any bonds or stocks in our portfolio? Personally, I don't think so. Again, unless you're an active trader, if you've decided that holding these investments is likely to help you to reach your goals based on things like their historical performances and how they work together with other assets in your portfolio, then for most of us, it's probably best just to stick with the plan, even if we suspect that the near-term future returns of the investment may not be quite as high as in the past. Let's take a look back at financial history and discuss why I feel this is the case. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. Okay, let's get down to brass tacks by first acknowledging the potential reality that many people bring up. As I said, all investments have their ups and their downs, and we all know that. But it's important to discuss when covering this topic, especially since I'm not sure that every investor fully appreciates the magnitude and universality of those ups and downs. With that being said, to put it simply, all investments can suck when viewed in isolation. To get an idea of what I'm talking about, take a look at this chart. It shows an estimate of the largest drops experienced by 6 different types of investments over the last several decades. Now, the data I have available to me only looks at the value of each investment once a year, so in some cases it doesn't quite capture the full impact of certain market crashes. For instance, the Dow Jones Industrial Average saw price drops of nearly 90% from its prior all-time highs by the time the Great Depression bottomed out in July 1932. Which is obviously significantly worse than the 68% drop shown here, but it gets the overall point across. Every investment is capable of experiencing extreme crashes, especially when you're accounting for inflation. Again, that's something that every investor already knows, especially when it comes to more traditionally volatile investments like stocks. But take a closer look at that chart. Would you have expected bonds, represented here by long-term U.S. Treasuries, to have lost more than half of their inflation-adjusted value at one point? Because that's exactly what happened between 1941 and 1982. And yes, you heard that right. The downturn technically took a full 4 decades to bottom out, at least on an inflation-adjusted basis. It took an additional 10 years to finally recover and set new all-time inflation-adjusted highs by 1992. And what about cash, represented here by Treasury bills, since I don't have data on savings account interest rates from 90 years ago? They lost nearly half of their inflation-adjusted value between 1933 and 1952, even though it technically never had a negative nominal return during that period. These are supposed to be safe investments. That's why investors are generally okay with accepting slightly lower long-term returns from them. And yet, the numbers tell a very sobering story. Again, every investment has its ups and downs. And no matter which investment it is, those downs can be pretty gut-wrenching and can last for a pretty long time. Does this mean that we shouldn't be holding bonds or cash as part of our allocation because they can sometimes lose almost as much as other, typically higher returning assets like stocks? Well, not necessarily. Again, while your ultimate decision will depend a lot on your own financial situation, time horizon, risk tolerance, and goals, I think we can all agree on this. At the end of the day, the thing we care about most is not how well any of our individual investments are doing, but rather how well our overall portfolio is doing. As an investor, I'm putting money away so that one day I can achieve some sort of financial goal, whether that be something as simple as having a rainy day fund, or something more elaborate like building up a new car fund, saving for a down payment on a home, building up a vacation fund, or putting money away for retirement. I'd love to see each and every one of my investments rise in value on a daily basis, of course, but I also know that that's not the reality of the world we live in. Investments will rise and investments will fall. What really matters is the overall trajectory of my net worth, or the value of whatever fund it is I'm building up, over time. As long as that number is, more often than not, trending upward at a rate that I'm comfortable with based on my time horizon, I'll be happy. And if modern portfolio theory has taught us anything, it's that different types of investments tend to behave differently than others in various situations. Therefore, having multiple types of investments that can balance each other out, such as stocks falling when bonds are rising, or vice versa, helps to ensure that I'm almost always making some progress towards my goals, or at least avoiding the worst kinds of financial ruin, i.e. when all of my investments are falling at the same time, which is more or less what we'd expect to see during rough patches if I built a portfolio where all of my investments are expected to be rising at the same time when things are going well. Let me show you how it works with an example. Let's start by taking a look at a simple all-stock portfolio where all of our money is being invested in a total US stock market index fund. This chart measures the 15-year rolling returns as well as the risk-adjusted return figures for a total stock market portfolio for the last 50 years. As you can see, on average, the investment has delivered strong inflation-adjusted returns of around 7.6% per year over all the available 15-year time periods since 1972, with a standard deviation of roughly 16%. However, it has also had its rough patches, falling by as much as 50% at its worst and spending nearly a third of its time in crash territory, or at least 20% below prior all-time highs. So in other words, good long-term growth prospects with some nail-biting moments. Pretty much what we'd expect from investing in the stock market. However, let's expand the scope of this analysis a bit and see what happens when we add some bonds to the mix. The second column shows the result of a 60% stock, 40% bond portfolio, with the stocks being represented by that total stock market index fund, and bonds by long-term US Treasuries. As we would expect when adding a lower return asset like bonds in place of some of the stocks, the average 15-year real returns drop. But in this case, it's not by very much, less than 1/4 of a percentage point in fact. This is despite the fact that bonds historically trail stocks by a couple of percentage points on average. In fact, here are the return splits for the stocks and long-term treasuries since 1972. So if bonds trail stocks by a couple percentage points per year on average over this time period, then why are we only seeing like a 0.2% per year drop in returns when we're adding such a large portion of bonds to our portfolio? Well, it's because these two balance each other out. You see, there's something magical that happens to compounded returns when you regularly rebalance a portfolio filled with investments that behave differently from each other. Let's take a look at how stocks and bonds performed in isolation since the turn of the century compared to how they performed together in that annually rebalanced 60% stock, 40% bond portfolio. Early on, stocks struggled as the dot-com bubble burst. They fell nearly 30% by the start of 2003. However, bonds rose by about 24% during that time frame, which helped to cushion the blow for the combined portfolio. Stocks recovered through the mid-2000s to the point that by the start of 2008, they were valued at nearly 20% above their 2000 mark, after adjusting for inflation. Bonds also continued to grow during those years, but not nearly as fast as they did when stocks were struggling in those early years of the decade. Then the financial crisis hit, and stocks plunged. Bonds, once again, rallied by gaining roughly 24% in that same year that stocks were falling, which, once again, helped to cushion the blow for the combined portfolio. Then stocks experienced the extended bull market of the 2010s. By 2021, they had tripled in value compared to where they were at the start of the century. However, it wasn't enough to make up for all the ground that they lost compared to the combined portfolio during those rough years of the early and late 2000s. Sure, the combined portfolio wasn't achieving nearly as high of returns as the all-stock approach was from 2009 to 2021, since it only held 60% of its money in stocks, but because it only held 60% of its money in stocks, it managed to hold its value much better during the tough times and therefore had a massive head start in 2009 when the bull market got underway. So that's why adding bonds to the portfolio only slightly decreases our average returns. Even when you extend the time frame to the last 50 years, the head start you gained during the tough times is hard to completely overcome. Another thing that adding bonds does is boost the results we see on the lower end of the return spectrum. The minimum 15-year real return from 1972 through 2021 for the all-stock portfolio was a little over 2% per year, which, while positive, is not exactly great over a decade-and-a-half long span, especially considering the amount of volatility and stress that the short-term fluctuations in the stock market can bring to investors. The minimum 15-year real return for the stock and bond mixed portfolio was nearly 3.5% per year. Still not exactly fantastic, but noticeably better than it was when we invested in stocks alone. The baseline returns measure the 20th percentile of the rolling returns measured in this sample. In plain English, 20% of the 15-year rolling returns came in below that figure, and the other 80% were above it. This makes it a very useful metric when trying to gauge what a more conservative return expectation for an allocation might be. For the all-stock approach, this came in at a little above 3.5%. For the stock and bond mix, it was a solid 5.5%. In other words, 80% of the time, a stock and bond portfolio would have earned at least 5.5% per year on an inflation-adjusted basis over any given 15-year period since 1972. Not bad, especially considering that inflation averaged nearly 4% per year during this period. In addition to raising the floor for your expected long-term returns, history suggests that adding bonds to an otherwise stock-centric portfolio will also lead to higher risk-adjusted returns, especially on the downside, due to the significantly lower levels of volatility. The mixed portfolio had a standard deviation nearly 30% below the all-stock approach in this case. Now, what if we take this a step further and add a third investment to the mix? Let's say we put 40% of our money into stocks and 40% into long-term treasuries, with the remaining 20% going towards gold. Why gold? Well, because for most of this time frame, it has struggled. In fact, it's actually had a negative inflation-adjusted return since setting its last all-time high in 1980. So it's currently going through one of those extended rough patches like bonds did from the 1940s through the 1980s, which makes it the perfect asset to use to see why, even during tough times, holding on to a diverse group of investments can be worthwhile for many investors. Here are the results. The average 15-year real return would fall to around 6.6% per year, which makes sense given that gold has struggled for the majority of the past 40 years. However, the return floor shoots up dramatically. It posts a minimum 15-year real return of 5.5% and a conservative baseline return of nearly 6% per year, which is honestly pretty incredible. Again, inflation has averaged nearly 4% per year since 1972. Which means that, at worst, a stock, bond, and gold mixture like this one would have earned something in the neighborhood of 9% per year on average over any given 15-year time period since 1972. And it would have done this with significantly less volatility and stress. A 9.6% standard deviation, a maximum drawdown depth of just 17% below prior all-time highs, and just 4% of its time spent in correction territory. So despite its struggles during the vast majority of these years, holding on to an asset like gold managed to significantly improve the consistency and dependability of the overall portfolio, cutting the volatility by a further 15% over the stock and bond approach, and halving the depth of the worst drawdown, while nearly completely eliminating the time the portfolio spends in financial purgatory. Yes, it did cut down on the average return figures, since gold has struggled so much for so long. But depending on how lucky, or unlucky you were in terms of investing at the right time, this may or may not have mattered all that much. And if all you really needed was inflation-adjusted returns of, say, 6% a year to reach your goals, based on your time horizon, savings rates, and other aspects of your financial situation, it may have actually made much more sense to go with this kind of diverse approach, which highlights an important lesson to keep in mind when building your asset allocation. It is entirely possible that an asset can be a critical component in your approach to reaching your investing goals, even though it struggles when viewed in isolation. Remember, as discouraging as it can be to see some of our investments performing poorly when others are thriving, trading, the thing we really care about is how well the portfolio as a whole performs and whether or not it's able to get us to where we want to be by the time we want to be there. And besides, like I said earlier, having some investments rising while others are falling can be a very desirable thing. It means that you're far, far less likely to find yourself in a situation where all of your investments are falling at the same time. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.